This video will be introducing the accounting concepts, which are the building blocks behind the transactions interpreted in the financial statements. We will cover the different accounting concepts in the slides to follow, so stay tuned. To introduce accounting concepts, we can define these concepts as the principles applied in the preparation to financial statements. Their purpose is to give clarity to the financial statements, as they form the basis of valuation decisions, which will then impact the way numbers are presented in the financial statements, and therefore allowing for better accuracy in reported data, which will in turn serve as more useful information for stakeholders. Accounting concepts are ideally intended for consistent application within a company's policies and practices, regardless of the different type of business. For example, a sole trader running a small convenience shop, a partnership business, or a large-scale limited company. The three main concepts include business entity, money measurement, and materiality, which we will cover in the upcoming slides, in addition to some other concepts. The business entity accounting concept interprets that the financial statements are based solely on the activities of the business entity concerned. For example, say a manager of a particular company has decided he wants a small office space, so he purchases a local office space and buys some furniture and a few computers with desks. These are not transactions made by the company where the manager is currently working, but rather these are personal transactions which would not affect a company's value as they are not company transactions. However, note that there is a link between individuals and the business entity only when the company owner or shareholder decides to add further equity into the business or when taking out drawings for personal use. The next accounting concept is about money measurement, which essentially interprets that money is the key indicator in defining a company's business transactions for the purposes of processing financial transactions to be illustrated in the financial statements. For example, say a business decides they are expanding their office space, so they need 10 new computers which they bulk buy from a computer manufacturer for $5,000 in total. As this transaction can be recorded in money value, we can therefore say that this transaction can be represented as a company transaction. A company cannot record personal traits or qualities of an individual employee or manager as part of the company's value, because these qualities are individual and cannot be recorded in money value to then be illustrated in the financial statements. The concept of materiality is about the significance of individual transactions in money value, whereby low-value transactions don't need to be recorded separately, as this would lead the expenses category to overflow and become complex. For example, when a company makes small transactions, such as cleaning office windows or decorations for the office for seasonal events, these will most likely present a low-cost value in comparison to other trading activity, particularly if the organization is large-scaled as a multinational corporation. Therefore, such transactions can be grouped together as sundry expenses, which is a category for generic expenses, and by grouping these small values together, the company can then report one value which is material for the purpose of reporting in the financial statements, on the basis that several small transactions have been accounted for. It is important to note that materiality is subjective as it is an area of judgment. Each business is different, particularly when considering the scale of operations. A large company will most likely define a material balance of significantly higher value compared to a smaller company. The accounting concept of duality interprets that each financial transaction will have an opposing impact, i.e. a debit and a credit, as illustrated in double entry bookkeeping. If you would like to further your understanding on debits and credits as part of double entry bookkeeping, please refer to the video link in the description below. The next accounting concept is about consistency. Businesses are advised to practice their accounting policies consistently to allow for more accurate decisions to be made, in addition to being able to forecast data on a consistent basis. For example, when a company decides the valuation method to depreciate certain assets annually, there are two commonly known methods. The straight line method is a fixed reduction in value each year based on the starting cost of the asset, whereas the reducing balance method charges depreciation each year based on the new net book value of the asset, which is cost minus depreciation. If the company changes their depreciation method annually, they will not be consistent in their valuation of asset depreciation. This will in turn lead to inaccurate reported asset values as well as profits, because depreciation is an expense which will reduce profits. Note that there is a common misconception that consistency must be applied in all situations. This is not the case, as companies may have valid reasons to change their valuation method of their accounting policies. However, the reason of the change must be reported in the notes to the financial statements. The concept of going concern interprets that companies prepare their financial statements on the basis that they will trade for the foreseeable future. This can be indicated by a company owning high-value assets, which will be used for the long-term future to generate value. For example, a company within a particular industry owns a factory that is specific to that industry. We can say that a clothing company owns a factory which contains machinery that is specific to the clothing industry, as the machinery assists to manufacture high clothing material. If this factory were to be sold to a different industry, say for example the motor trade industry, the value would be considerably lower because it will not generate the same benefit. This factory can therefore be recognized as an indicator of going concern because it shows the intent of the company to operate for the long term. We can note that this concept illustrates that companies should report items in their financial statements on the basis that they will trade for the foreseeable future. The accounting concept of prudence interprets that liabilities and expenses should be accounted for with immediate effect, even if there is uncertainty. They should make a cost provision, whilst any revenue or other income and profits should be recorded only when they are reasonably certain to be achieved. Therefore, prudence allows businesses to present their financial data in a more realistic manner, as there is often the self-interest to deviate a company's position with optimistic reported data. In the example, we can interpret expenses of a company, for instance, non-current asset depreciation expenses or writing off any historic debt which has not been repaid for several months, in addition to making further provisions for any doubtful debts in the future where the company might be uncertain of receiving debtor payments. By recording these expenses in the current financial year, whether they have occurred or not, the company is being prudent to give a more realistic picture of profits. It is worthwhile noting that this concept requires significant judgment, as senior management must decide valuations to avoid overstating income, in addition to ensuring that expenses and liabilities are not understated. It is better to show lower profits than higher profits that are potentially inflated, which would then mislead the owners of the business and other key stakeholders. The next concept is about accruals or matching, in which a company should report income and expenses when they are intended to incur in the income statement. This period of incurring the income or expense is likely to be different to the time period in which the transaction physically occurs. For example, say a company has received an annual invoice bill of $2,400 for computer software licenses in January. If they were to report this total cost of $2,400 in January's income statement, then the expenses would be overstated because they are reflective of the entire year accounted in 1 month. As this is an annual invoice, the total of $2,400 should be split into 12 months so that a cost can be matched to each month that the service relates to. Therefore, using the accruals concept, we can interpret $200 as a computer expense in January and vice versa for the other remaining months in the year. It is worthwhile noting that this concept is derived from income and expenditure accounting, which essentially entails that income is recorded in the month that it should have been recorded rather than when it was received, and expenses should be recorded when they are incurred rather than when the company is billed. As in the example discussed, an annual invoice billed in a specific month should not be recorded solely in that month because the cost relates to all months in the year, and therefore it is required to be apportioned accordingly. The concept of realization is about recognizing business transactions in the financial statements when legal ownership is transferred from the seller to the buyer. For example, a company may decide to purchase goods on credit from their supplier, whereby the legal ownership of those goods will have transferred immediately, whilst the payment transaction will occur later. Therefore, in this case, as the legal ownership was transferred in a specific month with the concept of realization, the creditor value owed later should also be recognized. Remember to note that the transaction date will not always be the same as the transfer of legal ownership date, hence where the concept of realization comes into effect, as mentioned in the example. To summarize, we have introduced accounting concepts in this video. Accounting concepts are principles which support the preparation of financial statements, which then allow key stakeholders to make improved decisions based on better financial information. We have discussed the fundamental accounting concepts of business entity, money measurement, and materiality. However, there are other useful concepts which we have also considered, such as going concern and accruals. Try to practice your understanding by noting down a few sentences using examples on what each accounting concept is about, and then revisit this video to check your progress. Okay, so that's the end of this video. Please like if you found this video useful or informative, comment with your suggestions or questions below, and subscribe for more breakdowns on accounting topics. Thank you for watching.